We've seen a lot of volatility in the market, and today major indices, as you can see in early trading, tumbled. And yesterday, President Trump was asked if he's worried that we could see a recession, and he said we could see a period of transition.
Record stock market declines in recent years, losing $4 trillion in a matter of days, the possible start of a bigger crisis than the one in 2008. Similarities to the nearly 30% slump of 2022. Trade war, tariffs, and uncertainty tearing stock markets apart. Wall Street, once a symbol of stability and growth, now reeling in uncertainty, akin to the dark days of economic recessions. Are we on the cusp of a new crisis, or is this just a passing storm in otherwise stable markets? Following the re-election of President Donald Trump in 2024, markets initially seemed to react positively. Investors celebrated the expected continuation of pro-growth policies, leading to rising stock prices, a strengthening dollar, and rising bond yields in the immediate aftermath of the election. However, the enthusiasm did not last long. Trump's erratic tariff policies, particularly threats to impose new tariffs on imports of goods from China and Europe, began to worry investors. Fears of an escalating trade war led to a drop in market confidence. The S&P 500 index fell by more than 9%. While the technology-oriented Nasdaq Composite fell by more than 12%. This dramatic loss in the stock market has wiped $4 trillion off the S&P 500's highs over the past few weeks. Wall Street, which until recently celebrated Trump's pro-growth measures, is now in the throes of uncertainty and fear. The situation was further exacerbated when the Trump administration announced plans to impose tariffs on European goods, including wines and cars. The move sparked fears of retaliation from the European Union, which could further damage global trade. Analysts are beginning to compare the current situation with 2007, when markets were at their peak before falling into a deep recession. Even then, markets were overheated, and investors ignored warning signs. Today, the situation is all the more serious because global political relations are more tense, making a coordinated response to a potential crisis more difficult. If high tariffs were to be imposed on European cars and trade between the US and Europe were to be curtailed as a result, this could lead to a recession that would be deeper and more difficult to resolve than the one in 2009. Unlike the financial crisis, where central banks could have intervened, trade restrictions would have altered the actual flows of goods and services, which would have been more difficult to remedy. In particular, measures against key trading partners such as Canada, Mexico, and China have reinforced fears of an economic downturn. The unclear situation has begun to affect businesses, consumers, and investors. Equity indices reacted with a sharp decline, with the S&P 500 index falling by 2.7% this Monday, and the Nasdaq Technology Index falling by 4%, its biggest fall since September 2022. The Nasdaq is thus in a correction, having lost more than 10% from its peak. The tech giants in particular came under severe pressure. Apple and Nvidia lost around 5% of their value on Monday, while Tesla fell 15%, equivalent to a loss of around $125 billion. Only defensive sectors, such as utilities, offered more certainty and managed to post modest gains. What is experiencing great growth, however, is the number of subscribers to our channel, so don't miss out on any of the top news from the world of stocks. Confidence in market stability was also undermined as the VIX Volatility Index reached its highest level since August. In a situation reminiscent of the 2008 crisis, investors' positions in equities have fallen to a slightly underweight level, which Deutsche Bank analysts have called the biggest retreat since Trump's trade war with China in 2018 to 2019. In the event of a further decline, the S&P 500 index could fall as low as 5,300 points. Which would mean a further loss of 5%. On top of all this, we have another interesting figure. If we look at a chart of the S&P 500 index, we now see a decline of less than 10% from the peak. This is the same decline that started the market correction in 2022. Just like now, 3 years ago, it broke a strong uptrend that lasted for several years. It subsequently fell below its 200-day moving average. When all this happened, the price plunged 27%. That would be a 4,400-point drop with today's chart setup. So the situation on the chart is very similar. investor concerns are compounded by the fact that there is a very interesting survey associated with it. The richest 10% of the U.S. population owns about 87% of corporate stocks and mutual funds, while the bottom 50% of the population owns only about 1%. This imbalance further increases the sensitivity of the markets to any economic fluctuations. But you can find out which stocks could benefit from this, or which ones can be bought below their fair value based on DCF and relative valuation, with the Fair Price Index on 𝗕𝗂𝗶ecie. Together with flash news, analysis, and the community, you'll be pricing stocks like the pros and won't be surprised by any market fluctuations. The similarities to the 2008 crisis or the 2022 downturn are disturbing. That's also when the panic in the market started relatively subtly, only to subsequently turn into a global economic recession. The current situation shows similar worrying features: sharp losses by technology companies, growing investor nervousness and uncertainty about government action. If trade disputes are not resolved in the short term, they could have a profound impact on the U.S. economy and global markets. Will the downturn continue, or have we already seen the bottom and a turnaround is coming? Share your thoughts in the comments, or directly on 𝗕𝗂𝗶ecie. Good luck with your investment.